All right, happy Sunday. We have Will Butler in the house. How you feeling, Will?
Feeling great. Happy to be here. Thanks for having me.
How was your weekend?
Low key. I'm still recovering from spring break from last week, with the kids.
What did you do? What did you do for spring break?
I mean, we didn't necessarily we're just doing random things. Like we didn't do no travel or anything like that, but with the kids all day, every day, trying to get work done. You know how it can be.
I
Mm.
sure do. Oh yeah. Yeah, we were in Salt Lake City for almost, I would say, 3 days out of their spring break, but they were in like spring break camp type of thing. So
Mhm.
they had I was like, I don't know how people travel during spring break with kids. Like it's just chaos in the airport.
Yeah, yeah. We got Epic Universe tickets again, and kind of like as a surprise for the kids, they don't know yet. We're just gonna say they're going to the dentist one day, ruin their morning, and then make their morning again by saying, "Oh, just kidding, we're actually gonna be at Epic." But we were gonna go. It's my daughter's birthday. What is today? 29th on the 3rd. I think that might be Friday. And we
Uh-huh.
were gonna go, but that's spring break for like other states, and we're like, yeah, we ain't doing nothing while it's spring break going on for other states. Nothing
No,
local like that, anyways. Yeah, it'd
no,
be terrible.
absolutely not. Absolutely. All right. Hi, Janet. Happy Sunday, Janet. I made the mashed potatoes that you sent. They were actually really, really good. The recipe that you sent. I will say is that my husband, he went and he peeled 10 pounds of potatoes. So I was like, oh my gosh. So I had to double the recipe and we had wait, I thought we were gonna Oh, I was gonna just buy it for everybody. Oh, sorry. Um, so we ended up having to double the recipe. We had so much mashed potatoes, but it didn't go bad anyways because we leftovers over here. Do you like leftovers, Will?
Do I like leftovers?
Yeah.
I mean, I don't have a problem with leftovers, not
Some
at
people
all.
that I know who do not like leftovers. Like they just they're like, nah, I'm good, like type of thing. I don't eat leftovers. I love leftovers. I think that they taste better a few days after you cook it, especially pasta. I agree.
Pasta, yep, spaghetti, things like that for sure.
Will Watson is saying hi. He's saying, hi, this is Watson.
Hey, Watson, thanks for tuning in.
Hey, Mr. Grice. Is that you? Hey Katrina. Katrina's on here. Hey Karen. See, I'm telling you, see, I don't eat leftovers. I'm telling you, there are people who just don't eat leftovers. Yo,
Can't
leftovers.
relate.
And that's what we were talking about before. I know it. I'm like, I know that that was you, but um like we were talking about that, we actually, one of our past clients had us over for dinner yesterday, and we were talking about leftovers and things like that, and she was like that she doesn't really meal prep, right? Because she just cannot, like, by Tuesday she's just like, okay, no, I can't do this. It's the same food and it's the leftovers.
Yeah. So are we talking about like I don't want to have leftovers 2 days in a row, like the same meal. I can't do the same food like 3 days in a row or anything like that. But I can eat something like I can eat a pizza the next day, day after, 3 days later, no big deal. And you
Oh,
got an
with
air
pizza
fryer?
you can.
Hmm.
You could do that with pizza.
Oh yeah, yeah. With an air fryer, oh, I could eat a lot of things left over that I normally would not touch if it were not for an air fryer. Like fries. Fries are terrible unless you have an air fryer.
That is very true. You know what is also terrible? And we'll get into the good stuff, but so Publix, right? Publix has some pretty decent chicken wings that they already like make, but the
Hmm.
only thing is that because they sit there in the warmer, right? By the time you get them, they're soggy. There's not like crispy, cuz when I eat chicken wings, I want crispy chicken wings, right? And so I just pop them in the air fryer and super good.
Game changer. Yep.
Game changer. Katrina said next day pizza is amazing.
I agree.
Karen
Not
said
microwave though.
no, not microwave. I could eat pizza cold too, though, but I prefer. I if I had to, I would. But Karen said, growing up, we didn't because my dad didn't care for them. But now I do all the time. Can't afford to waste anything nowadays. I felt that, especially with $4 gas prices. Hey, James. Karen said yes. After the second day, I'd rather not accept my mac and cheese and pizza. Okay. Wit said if you call Publix 45 minutes ahead, they will make them fresh for you. Okay, I need to do that. Katrina said no microwave, air fryer, reheat vibes. LOL. Jada said lasagnas the next day is the best. Yeah, I agree with you.
Mm-hmm.
All right, well, I know you guys didn't come on to speak about food, but you never know, right? So tell us what's going on. What's going on in the financing world?
Oh, so it feels like a loaded question. Let me actually pull
No.
up rates today. Um, you remember a few weeks back, you heard everybody was talking about how rates hit a 3-year low, rates below 6%, all that stuff again. Do you have an idea where rates are today?
Now, me
Right now? Yeah, just curious.
in the mid sixes?
Mid 6.64.
Mm-hmm.
That means if you were somebody that was looking to do some 3 weeks ago, or even before the war started, because that's really kind of the catalyst that's impacting everything as much as it is. I mean, and you were getting, let's just call it a 5.9 where the prime rate was, and then same exact client 3 weeks later because you sat on the sideline. Now you're at a 6.6, right? So that's a stark difference between the two. And depending on the price of the home that you're looking at, I mean, that could be $150, $200 a month just from that one little change. So, and the other thing as well that I think is important to note, we were supposed to get 3 rate improvements this year, meaning rates were supposed to go down 3 times this year. With the war and with inflation, it doesn't look like there's going to be any more decreases this year. It looks like the counter to that, it looks like rates are on the way up. So there's no benefit in even trying to time the market or doing anything like that anyways. So do with that information what you will, but that's kind of the outlook of where we are. And I don't want to leave that with you guys like to paint a grim picture, because I think that creates tremendous opportunity, especially if you're an investor, especially if you're buying your first home, anything like that. Because what happens is when people are fearful, what do they typically do? They start pulling back. They say, you know
Mm-hmm.
what, I'm gonna wait. And what happens is when the more people that decide to wait and the more people that decide to do nothing, that leaves more opportunities for the people who are diving in head first to create some opportunity. And that's kind of what happened in 2020, right? There was a lot of people who pulled back a little bit and during the COVID, or at least the initial part of COVID, until people got sick of it, and then they started buying houses and things kind of exploded. But I mean, that's kind of the state of the market where it is right now. Inflation doesn't look great, so I wouldn't count on your groceries or anything like that getting cheaper either. Um, oil, anything that's shipped, which is almost everything, right? All your produce, all those different things, all that stuff's going to go up because now the shipping costs are higher on everything because gas is up, 60% from where it was 3 weeks ago. Or
Mm-hmm.
oil, rather. Yeah.
Yeah, it's crazy when I think we filled up the truck and it was like $100, which normally is maybe like $60. So it was like
Mhm.
an extra $40. And I'm just like, oh my goodness.
Yeah, that's fun, especially when you do so much content all around the
Oh
state,
yeah. Oh
Yeah.
yeah. Being that there was a big, I would say, gap, right, from where we were 3 years. What was that phrase you used? Historic low within
Well,
the past
rates
years,
were,
right?
yeah, I mean, a 3-year low.
Yeah, 3 year low. From then to like now, have you seen a lot of people where they no longer qualified for the loan that they were under contract for, or that they have a rate lock? Like what did you see happen?
Yeah, in the last 3 weeks is what you're asking me.
Yes.
I always advise, especially because we don't know what's going to happen. Up front, if you're comfortable with the payment, everything looks good, then I typically almost always recommend just lock it in. And so thankfully, all my clients did lock in as we're going through the process. Like we typically don't allow things to linger. And that's why speed's so important. I got some buddies of mine who, this was like last week or what have you. They had a client, they were ready to go. And then boom, overnight, they didn't lock it Friday. They got the contract Friday. They didn't lock it Friday. They said, I'm going to take care of this on Monday. And what happened? Now the same exact rate, the same exact payment, everything now is higher. And that's a tough conversation they need to have with the client. And, that's obviously something you want to avoid as much as possible. But sometimes you can't avoid it. If you get that contract at 8 o'clock or 9 o'clock on a Friday, like you can't do anything at that point, right? It's just, we'll take care of it Monday morning when the markets reopen. So I would suggest right now, if you're on the fence, you're considering doing anything, like understanding what's going on with the market and that there is no more expected declines in interest rates this year. If you are going under contract on a house, anything like that, just lock it in right away because the chances of it going down are slim.
So what does it look like? Talk to us a little bit about what does that look like to lock in an interest rate? Like what is there a cost to that, right? What are tell us a little bit about that.
So whenever you're locking in an interest rate, there's always a cost for things, right? There's no cost initially up front for you to lock a deal. But for us as a lender, let's just say it's free to lock a loan at 30 days, 45 days, whatever the case may be. But the longer a rate lock is, the more expensive or the more money it would cost to actually lock that in, right? So if something costs essentially nothing to lock for a 30-day window, if you wanted to extend that to a 45, 60-day window, 90-day window, that same exact rate is going to cost you a lot more money because there's costs associated with it, even if you don't see it up front. So what happens is, from a lending perspective, if we locked in a loan for 30 days and God forbid something happened where we couldn't close on time because there was inspections, there was appraisal issues or what have you, and now we have to extend the loan or extend the rate lock rather, there's a cost every time you do that. So if we need to extend it for 2 weeks, that same loan that was costing nothing to do now may cost you money to extend for another 14, 15 days, however long you need to extend it for.
Got it. And what are the prices based on? Is it based on what the interest rate is, or what are the prices based on?
It's based on basis points, which is essentially a percentage of the loan amount.
Got it. Okay. So that would be, it's not something where it's kind of like a flat number and it's a flat fee type of thing. It's going to depend on every situation. Okay.
Yep.
I mean, that I guess that makes sense. Karen said they need to get everything sorted by winter 2027. I need it to become a seller's market so I can sell my condo for good profit. James said the roller coaster continues, unfortunately. So do you guys have any specific lender questions since we have Will on here? Will, any new programs that have came out or?
I mean, I want to say necessarily new programs, but programs that people aren't familiar with that's super helpful. For example, I'll tell you a story. We're doing a loan right now for an attorney who they got pre-approved initially with Wells Fargo. And Wells Fargo, it's a jumbo loan. It's a $1.2 million property. And they got approved for a jumbo loan at $1.2 million. And they were going to bring 20% down to be able to meet the criteria for Wells Fargo to do a loan at that loan size. Come to find out, they went under contract. And then, hey, we never said we had 20% down. So Wells Fargo never verified any of the money. They're like, I mean, we can do like 5%. And, the agent who's in your office, Libby, she calls me. She's like, hey, I showed these people a bunch of properties. I don't want this home to fall through. Is there anything you can do? We're doing a loan right now for attorneys. So this is important to note. If you know anybody who's an attorney right now, up to $1 million, an attorney can buy a home with zero down as a down payment, up to $1 million. From 1 million to 1.5 million, it's just 5% down. And then from 1.5 to 2 mil, it's 10% down. Now I say that because this is a product we've had for a while. However, it's not a product that we talk about often, right? Mm-hmm. And maybe because we don't want to alienate our clients or what have you. But it's such a lucrative product that when I spoke with them, now this was a deal that wasn't a deal. They were going to miss out on a house that they couldn't buy. So now they can qualify. They're actually closing on is it the 8th? Yeah. In like 8 days or something, 8 or 9 days, something like that.
Wow. So
So
you saying this specific loan has been around for a while?
it has, yeah. I mean,
So
we've had it for about a year.
okay. And I'm just curious, why would they make a loan just like specific for a lawyer? Do you know?
I mean, the lenders, they all have different kind of risk thresholds and things of that nature. And sometimes, like, I'm sure you've heard of doctor loans, right? So it's just for certain types of individuals that they'll create a product where they feel confident in these people's ability to repay a loan. So they create a niche product to be able to serve that specific market.
Um,
Because this loan isn't just attorneys; it's attorneys, it's doctors, and as well as CPAs. So if you hold a license for any of those professions, this is something that you qualify for. Now, keep in mind, you can't own another home at the time of closing with this product. Or if you do own another home, the home that you're vacating has to be listed for sale, and you have to have an executed contract on that house that you're vacating. So I can do it if I'm selling my house and then buying a new one. But if I'm going to retain the property that I currently have, I cannot use this product.
got it. Okay, okay. I mean, yeah, I guess that makes sense as far as having a niche for a loan,
Mhm.
because you, of course, you have one for self-employed and all this other stuff. So with Axe, can they rent the other home?
With what?
If for that loan you said that they had to sell the house, right? Can they rent it out or no?
For that loan product, no.
Okay, so they could only have one house.
Correct.
But what if they had like what if they were also investors and had like a portfolio? They couldn't.
Yeah, you just can't use that loan product. I mean, you can still finance it, but you can't use that specific
That
loan product.
loan, yeah.
Mhm.
Okay, okay. Okay, Will, if I wanted to go from 6.64%, from how much would it cost to be 4%? So from 6.64 to 4%, how much would that cost?
Um, it's all relative. It's kind of a loaded question. It depends on what your credit score is. It depends on the price of the home because it's all percentage based. I could tell you that to get that rate, it's not going to be cheap. It's going to be very expensive. And when I say that, like it's probably going to cost several percentage points to be able to do that. So, for context, if you're buying a house at $300,000 and I wanted to get it down to 4%, um, I mean you might be spending 25, 30 grand just in discount points to buy down that rate because it's so far below where the actual prime rate is today.
Mm,
Whenever you're buying down a rate, you're typically not getting it 2 points lower, right? Whenever you're buying down a rate, it's usually you're getting a 0.5%, something like that. And in most cases, the typical buy down is 0.25%, 0.5%, something like that. And you're typically not buying it down 2.5% because the cost associated with it is so disproportional that it doesn't make sense. Um, for example, I'm dealing with a client right now. They're doing a temporary buy down, which I think temporary buy downs are pretty cool products. Because what a temporary buy down is it temporarily buys down your interest rate. So let's just say today you're at a 6.6 because the prime rate today is a 6%. But let's keep it actually simple. Let's just call it 6%. All right, just to keep the numbers extremely, extremely simple. If I wanted to buy a home, you can do what's called the temporary buy down so that it's not a permanent buy down on your loan. Your rate's still going to be 6%. But if you did a 3-year buy down, it's called a 3-2-1 buy down. Year one, your rate is 3%. Year two, it's 4%. Year three, it's 5%. And then year four and beyond, it's whatever the actual rate of the loan is, which is 6%. But the reason why this is a great product is it helps keep the barrier of entry when you're purchasing a home as low as possible. Now, granted, your payment will go up if if your interest rate goes up, which it does. So it's 3 years lower year one, 2 years lower year two, 1 year lower on year three, and then it's whatever it is year four and beyond. Um, so it's helpful to keep that cost down. But what most people are going to do when utilizing this product is they're going to probably, like, I'm willing to bet that at least 90% of the people who are buying a house or have bought a house in the last 3 years are going to refinance in the next 3 years. I'm
Mm.
willing to bet that, because we can't sustain the trajectory that we're on in terms of interest rate and inflation and affordability. Like, it's not sustainable to keep on going down this path forever. And I feel like what's been happening over the last 4 or 5 years is kind of just pushing the can down the road, right? It's just kind of like, well, let's put a band-aid on this so that it's so, and then we'll figure out a long-term solution down the road. And then you have tariffs that came in that were supposed to solve the problem, didn't solve the problem. Depending on the media you look at, it'll say it's solved, and then the other one will say that it's not, right? But problem's not solved. Now we're in a war, and regardless of what you think about the war, if you think it's a good idea or a bad idea, economically, it's not great for the world. It's not great for America, and it's not great for the average person in America, financially, because everything's just going to get more expensive because of it. Iran holds 20% of the oil reserve in the world, right? Or 20% goes through the Strait of Hormuz. If they're going through war right now, and there's no longer, that oil can't be shipped through that Strait of Hormuz, which is 20% of the world oil, things are going to get more expensive, because now, if you were used to getting 100 barrels of oil just for conversations, like, now you're only getting 80, which means the cost of everything that I need to ship is going to go up. When inflation goes up, so do interest rates. Now, when you look at the job market, everything, all the reports on what America is right now, rates should be going down. But if inflation's going up, rates can't go down. So what needs to happen is things need to get much worse for rates to actually come back down. And with war, there's a lot of uncertainty. People aren't really sure what's going to happen. I mean, I'm not sure what's going to happen. The only thing I know is things are going to get more expensive. But outside of, like, the actual results of the war, nobody knows.
That's
I'm sorry
deep.
to be doom.
That
Yeah, I don't
was
want to be doom or gloom, but
no. Yeah, I mean, it's reality, right? So okay, so James said builder incentives usually appear to limit the pain in times like this. So that's where a lot of people tend to go with builders, new construction, especially the bigger builders, where they have the funds to be able to already prepay for those lower interest rates, right?
Mhm.
So that's why I sell a lot of new construction. And now I'm glad that I have you on here, because I've seen a lot of even the builders, their preferred lender, where they're pushing like a 5-1 arm, whether it be a 5-1 FHA arm or conventional, right? Can you tell us what that looks like, what that actually means?
What a 5-1 arm means?
Yes.
So a 5-1 arm means that you have a fixed rate for 5 years, and typically, in theory, the rate should be lower than what the prime 30-year fixed rate is, right? And so you may not be getting like a 0.5% lower, but you could be getting a 0.25% lower than what the prime rate is. So as opposed to a 6.6, you might be getting a 6.4. With the idea that you'll probably refinance or sell your house in the next 5 years anyways, so you don't have to deal with the fluctuation or increase that occurs on an adjustable rate mortgage. So when you see 5-1, that means that it's fixed for 5 years, and then after a year and every year thereafter, the rate moves up and down with where the market actually is.
So
So if
what is
rates go up, your rate goes up.
like it does it depend on the actual, the buyer and what their file looks like to see if it's even beneficial? Like, what is your take?
It depends on what their goals are. Right. So there's not a one size fits all in mortgage. And if you believe that there is, then you probably shouldn't be a loan officer. Because if I know your goal, for example, let's say, well, hey, look, I want to buy this house and I want to live in it just because I want to participate. Like, I want to buy it strictly to participate in the appreciation that I know that's happening in this market, in this area. And I want to hold it for like 4 years. Outside of that, like I'm going to sell it no matter what, and I don't want to have to deal with anything. I just want to participate in all of that appreciation that happens over the next 4 years before I decide to do anything. Somebody who's telling me their goal is to get rid of the property in the next 5 years, then it's a great product for them. But if you're somebody who's not risk adverse and you want to buy a house to be your forever home, right? Maybe it's not the best thing for you, because after 5 years, if the market is higher than it is today, now your rate's going up, your payment's going up. So it just kind of depends on what your goals are and the purpose of the purchase. And then you tailor fit a mortgage to fit whatever their goals are. Because what we come across quite a bit, like ARMs can be helpful. Like I'll give you an example. If you're you're holding a short-term loan, then interest rate doesn't really matter that much. Here's what I mean. If I were to buy a house today, and let's just say I have a 6% rate and I have a 10% rate, you may say, look, obviously I want the 6%. 4% higher interest rate feels like a lot of money. But if I'm selling the house in 2 months and I'm doing like a fix and flip, anything like that, I could, in theory, sell the property before I even have to make a mortgage payment. Because typically your payments don't start until roughly about 45 days from after you close. So if you close today, it's March 29th. So if you close, I'll give you a great example. All right. So today, if you close on a home on tomorrow or Tuesday, okay, your first payment would be May 1st. So you only have about 30 days. If you close on April 1st instead of the tail end of March, your first payment is not till June 1st.
Mm-hmm.
So now you get to go essentially 2 months without ever making a payment. So you always skip the payment for the month that you close in, and then you skip the following month as well to kind of give you a window of not having to make another payment again. So if you close at the very beginning of a month,
it's essentially in your prepaids, no, for the next month.
It is. So your closing costs will be higher if you're doing that, but you're not having to pay the principal or anything like that. So if you got a $4,000, a month payment for conversation's sake, I mean, you may have to, in your closing costs, it might be $2,000, but you're not having to pay for, and then it extends your payment all the way through, another 30 days or what have you.
Yeah, that's what I tell a lot of my clients too. I always tell them where it's just like, so we like to align as much as possible, especially like, let's say if their lease is up, right, in a certain time, where it's just like they think that they have to start maybe a month before, and I'm like, no, that's not it, because you're always gonna have that gap. So we could, we'll start. I'm just using as an example, where it's like, okay, if your lease ends in the end of July, right, we could essentially start looking in, let me see if I get this right, in March, right? Let's say we go under contract in April, we close in May. Depending on when we close, your first payment is not due until July, right? So it's kind of
Right.
like where not that there's a loophole, but it's just kind of like where it works to the buyer's advantage.
Right. And that's why it makes sense to always work with somebody who knows what they're doing, right? Because like you knowing that and understanding that, it, like sometimes you have people who they're like, well, I'm going to wait. And then they work with an agent who doesn't like say, hey, look, we got to figure out the time. We have to figure out the window. And then they try to do something 30 days before they got to make something happen. And then they can't make it happen in time. And now they're stressed, and now they're trying to figure it out. And now they're settling on a home that they don't even want, or they're going to rent another property that they didn't want to rent.
Yeah.
Right.
Yeah.
And,
I've seen it so many times.
Yeah.
So Wit says that Colin Bill is doing 3.75 fixed. That's actually really good, Wit. So that's with Kalesa Township. I don't know if that applies for On Top of the World in Ocala. I'm pretty sure, because it's the same builder. Okay, Marianne. Hey, Marianne. Jeff told me to ask you to Okay, Will, who are the top 3 mortgage lenders to go with today? Who would he recommend, and should we go ahead and lock in with them? So, let me jump in before. Since you're looking at big builders, right, such as we saw Holiday Builders yesterday, right, their incentives are tied to their preferred mortgage lender, right? So you would have to use their lender in order to access their incentives. Now, sometimes where it's like, if for whatever reason you try to get approved with their preferred lender, and they are not able to approve you, then that's where we can come in and be like, hey, well, we have Will here from Magic Mortgage, who can in fact approve you guys, right? Who can approve them. And sometimes it's where we're still able to get most of the incentives as well, right? So we've done that a couple of times already, where it's like my clients couldn't get approved direct, because what you have to remember is that a lot of the times the big builders use just like a big bank, one big bank, right? And so if you don't fit into their box, right, then you don't get approved. But that's not to say that you couldn't get approved somewhere else. So that's one of the reasons why I like to work with Will, because he's a mortgage broker, which means he has access to so many different banks, and he can shop around to see what's the best option for you, who's going to be able to approve you. So we have one client. No lie, I'm telling you, I love working with Will. We get it done. So we have one client who didn't have the best credit score, and in the area that she was looking, right, we only had, out of all of the banks that he had access to, it was just one that she was able to close with, right? And so had we just went with a big bank, right, or someone else who's just not like, okay, Will's a, let me see, like, let's come up with answers, let's come up with a solution, right? And he found the bank, and we were able to close on that house, right? So who you work with definitely matters. So again, to recap my answer, if you're going with, let's just say, Holiday Builders, and you're going to finance, if you want their incentives, you would have to get approved through their lender. And if not, Will's my go-to. That's just hands down.
I appreciate that.
Mm-hmm. Okay, and then Jeff told me to ask, how much leverage will the buyers gain with higher interest rates? I mean, I don't know that it's something to leverage, right? Where, of course, now it depends, right? Because again, I feel like it always comes down to the person's situation, right? So sometimes, somebody has to buy, right? Or somebody has to sell. So I always feel like, number one, there's a house for everybody, right? And number two, where it's like case by case scenario. So honestly, and if somebody's very like conscious of their interest rate and their mortgage payments, right, and are considering a new construction, then maybe the big builder is the go-to, right, because they're offering that lower interest rate. Because sometimes, right, the mortgage brokers can't compete with what the builders are offering as far as interest rates are concerned, right? Because as Will mentioned, to get to, let's just say, even a 4% from a 6.6, it is going to cost tens of thousands of dollars, right? But you have Colin Built, where Whit just said that they're giving you 3.75 interest rate. I actually seen, so one of my clients, they went with Casa Fresca, and they were offering, and that's why I brought up the ARM, because they were offering, I think as low as, no lie, I think as low as a 3.25 with the FHA 5/1 ARM, right? And so the way the lender explained it to him, where my buyer was just like, I mean, it makes sense for me, right? That's what he said. It makes sense for me. And as long as it makes sense for you, that's all that matters, right? Because it may not make sense for me, but that's me being in your pockets, right? Like, if you have a clear explanation of, like, a clear understanding of what it is, and you're fine with that, then, Right. So
can I piggyback into that? Onto that? All right. So to answer your question, though, if you are buying something that is resale, higher interest rates typically means less competition on offers, right? So when there's uncertainty in the market, people get fearful and then they pull back and then they wait for things to settle and then they move. So you can leverage that to actually get the house you actually want, not the one you have to settle for. When everyone there's like spikes in demand and everybody's looking at properties and you got 20 offers on one house, you lose all of that leverage. When you're the lone offer that's going in on that property, you may be able to negotiate repairs way easier. You may be able to negotiate a lot of closing costs, which Alexis is a beast when it comes to that stuff, right? Making sure closing costs are being covered by the seller. And I would say like over 80% of the contracts that are coming across my desk over the last even year have closing costs paid for by the seller, or at least like not all of it, but at least a portion of it being paid for by the seller. Right. And so there is leverage there because of the fear, because of the uncertainty. And right now, over the last 3 weeks, there's more of it. So use that to your advantage and actually get into those properties, because what's happening right now is there's such a big opportunity. I so Can I share a story that doesn't have to do with mortgage, but I'll tie it
Of
back in
course.
with how it tries to mortgage? All right. So I have a podcast. We had a podcast with an insurance guy yesterday, and he built a pretty significant insurance company to over 70 employees, and he's been in business now 15 years or something like that. But the reason I'm telling you this is up until COVID, they were like 6 or 7 employees. When COVID happened, there was a lot of trouble with insurance. Insurance brokers were having hard times even writing policies because there were so many insurance companies pulling out, that the only company that was doing it was Citizens, right? Citizens was the only company writing insurance policies for like 2 years in Florida. So everybody was getting insurance quotes from Citizens. The problem was, because Citizens was being subsidized by the government, the commissions also compressed for all of the insurance agents. So, and when I say compressed, I mean by more than half. So if they were normally making, let's just call it $300 on a policy, now they're making $150 overnight. So what happened was there were so many people that were pulling out, or there was a lot of people even staying in, but they were not making the phone calls and trying to grow their business. They weren't doing the things that would grow your business in that season because so many insurance companies were pulling out. And what they did is they just doubled down. They said, well, while everybody's fearful, right? This is a quote from Warren Buffett. When everyone is fearful, be greedy. And that's what they did. And now they're the biggest like local insurance company in Central Florida. Now they have 70 employees and their business has exploded because they doubled down in that market and they grabbed all of that market share. Now, let me tie that in with like how this applies to you right now. I'm sure you guys have seen that Florida is trying to pass a bill to remove property taxes on your homestead properties. Who knows if it's going to happen, right? But what I can say is there has been movement in the right direction to make that happen. And if you're on this Zoom or whatever this is, YouTube Live, if you're on this meeting today, I hope that, and I pray that you would vote yes if that hits the ballot, or when that hits the ballot in November, to remove property taxes on homestead exemption. Because if you own real estate, that is a massive win for you. Here's what I mean by that. If you're buying today when it's fearful, and let's say it goes on the ballot in November and then takes effect in 2027, but you own the real estate, all of a sudden, like if your property tax bill is $6,000 a year, which isn't uncommon, I think that might even be a lower number. But if it's $6,000 a year, you just save $500 per month.
Who wants to save $500 per month? Because I do.
You just save $500 a month. If you're renting, that discount is not being passed to you. So what do you think is going to happen to demand if that actually happens? It's going to go up. Mm-hmm. So you want to be the person who's holding a position in the path of progress to capitalize on all of that when the time comes. And if there's anything I know, it's this: 5 years from now, 10 years from now, 20 years from now, 100 years from now, people are still going to need somewhere to live. I think it's a safe bet.
No, I completely agree. And going back to, it also comes down to, all right, the whole leverage conversation, right? It's also going to come down to the seller too, right? Because there's a lot of sellers in this market where they're like, I'm gonna test the market. I don't really have to sell, right? But I'm gonna, if the right offer comes by, then I'll sell it, right? And we've seen it time and time again where, no lie, like a house will be on the market for 6 months, right? And you think that the seller would is willing to go ahead and negotiate and all this other stuff, and some of them are just like, no, I want what I want and that's it, right? And then you have to make the decision on, do I really love this house, right? Is it for me? Because sometimes, and I actually had this conversation, and we're about to close. Well, Will got the clear to close way in advance because we weren't closing, so I think another 2 weeks. But it was a situation where the seller had, unfortunately, I had to work directly with the seller because they use kind of like a flat fee brokerage just to put it on the MLS, but you end up speaking with the seller. Anyways, he was like that they had multiple offers, right? And there's really no way to it just comes down to ethics, right? And he doesn't hold a license, so he doesn't have to be, ethical, right? So it really comes down to, do you really love this house, right? They're saying that they have multiple offers. Do you want to take the chance on, passing it up, or do you want to go in with a strong offer? And unfortunately, it's not a great position to be in, especially if you really, really want the house, because you just don't know, right? You don't know if they truly have an offer. So it was where my clients were like, no, we really want this house, right? And so it's kind of like, okay, so the strongest offer is this, and it's not asking for closing costs, right? And then I had to kind of like reposition it, and it's like, would you be upset if you lost this house over $10,000 towards closing, for closing costs, right? They didn't give it to you, and they were like, yeah, I would be so upset because we really want this house. And I was like, well, then that's your answer, right? Sometimes buyers are like, oh, well, I don't, this is, if it works, it works. If it doesn't, it doesn't. We keep it moving, right? But this particular family, they really wanted this house, and so at the end of the day, you have to make it happen, right?
Right.
So okay, hold on. Okay. Quick question. What are the average mortgage rates looking for a 15-year fixed rate with 20% down?
Well, I'll do you better. Go to mortgagenewsdaily.com.
Mortgage News Daily. I'm going to write that. mortgagenewsdaily.com. Okay.
This is a third-party website publication that basically tells you what's going on in the market, publishes articles almost every single day, lets you know what's going on in the world of mortgages, and it also publishes the prime rates for each product, right? And when I say each product, I got to be careful with how I say that, because these are only products that are insured by, or backed by Fannie Mae, Freddie Mac, right? So government sponsored essentially types of loan products. It's not going to have like bank statement loans for self-employed people, the attorney's loan we talked about earlier, anything like that, because those are niche products that aren't being backed by the government essentially. So when you look at this though, and you scroll down, like you'll see a chart that says MND's daily rate survey.
Are you able to share your screen so we could see what you're seeing?
Sure. You guys see this?
Yeah.
All right. So if you look here, you'll see mortgagenewsdaily.com, and it publishes the rates. Now, keep in mind today, you're not going to see any adjustments because it's closed on the weekends. The market's closed on the weekends. But around 11:30 tomorrow, you'll be able to see where all of the prime rates are. So you'll see a 30-year fixed here, 6.64. That's a conventional 30-year rate prime. And then you have a 15-year, which you'll see it's a 6.15. So the shorter the term, the better the rates are typically going to be. And then it shows you jumbo here. And then it doesn't show you all of the arms, but right here you'll see a 7.6 arm. And a 7/6 arm means that it's fixed for 7 years, and then every 6 months the rate's going to adjust. So remember when I said your rate would probably be like 1/4% better if you were to go with an arm as opposed to a fixed, and that's kind of where it shows you. It's a little bit better. It's 0.3%, so 0.33% roughly better by doing an arm as opposed to doing a 30-year fixed. And then you have FHA, and then you have VA. Which the FHA is a 6.1 and then the VA is a 6.12.
Why is it that builders are able, for the most part, are able to get the FHA and the VA interest rates lower than the conventional?
Hold on, let me close that. All right. Well, the reason is that they are so for a couple of reasons. First off, most times, almost all the time, the preferred lender that is building that home also, or the preferred lender is owned by the builder.
Yes.
So, they own the company as well. So they're subsidizing the cost. They're building that stuff into the price of the home. No doubt about it. But they're subsidizing that cost through the margins that they got from the actual build, from the real estate side. So, they have, the 30K or whatever that they're using to buy down the rate. And then they'll go directly to, Fannie Mae or Freddie Mac, the lender will at that point in time. And then they'll buy in bulk for like 90-day windows. So they'll buy, let's just call it 1,000 loans. And they'll pre-buy those interest rates in a particular bucket. And the buckets are above 640. The rate is going to be this. Below 640, the rate's going to be this. And here's how much it's going to cost, regardless if you're at a 700 or if you're at a 640. They just get the rates, they buy them in bulk. And because of that, they have the ability to do that because all of the margin that's built in through the actual build out, they can use those funds to buy down the rate in advance and all of those different things.
Okay. I mean, that makes sense, I guess.
Does it? Do you want me to expand on it?
No. So, okay. Conventional has PMI. What is it called with FHA? Because it's not called PMI, correct? It's called something else.
MIP.
MIP. It's the same thing.
Yeah, well, FHA does have PMI, and it has another thing called MIP. MIP is FHA has like two, right? So PMI, MIP, kind of the same thing. So one says private mortgage insurance, the other one is mortgage insurance premium. Like, whoop-de-doo, right? But I mean, with PMI, anytime you have less than 20% down on a conventional loan, for example, you're going to have PMI on your loan, and that insurance is essentially there to protect the lender in the event you stop making a payment. Like their collateral is still going to be covered, right? So that's what the mortgage insurance is to protect the lender if you stop making payments, and they're not going to lose the $500,000 or whatever they lent you to be able to purchase the home. With FHA, they have that as well, but they also have a thing called a funding fee, right? So they have a monthly, and then they have what's called the funding fee. The funding fee is 1.75% of the base loan amount. So think of it like this: conventional, your mortgage insurance is dictated strictly by how much you're putting down. So the more you're putting down, the less the mortgage insurance is, as well as what your credit score is. So if your score is below a 720 on conventional, your mortgage insurance is going to be disproportionately higher. Your payment will be higher if you're below a 720 on conventional than if you were buying a house with FHA, because the mortgage insurance premium is a lot higher than it is on FHA. For example,
the insurance premium is higher with conventional.
If you're putting the minimum down, right? If you put 3% down, you have a mortgage insurance premium. And then if you put 5% down, you have another mortgage insurance premium. So it scales with how much you're putting down. And then as well with the mortgage insurance with conventional, what is also taken into account is what your credit score is. So like, I'll give you a perfect example. I did a loan for a client that he wanted to do a refinance. So we were doing a refinance, and we were going FHA initially because he thought that he had like 10% equity, nothing crazy, and his score was a 646. When we priced it out, conventional 646 credit score, like his interest rate was a lot higher, and so was his mortgage insurance. So for the same exact property, same exact everything, I mean, we're talking $100 more to go conventional than it is to just go FHA. So he's like, well, I want to get the payment as low as possible. Let's just take it FHA. So we went that route. Come to find out, he had a septic tank, right? So he had to do a septic tank inspection for FHA guidelines. When they did they pump it or they do whatever they do when they test the
Oh my
septic,
gosh.
and it flooded. So it failed the septic tank inspection. And that was the only condition that was left to close on the home. So what ended up happening was, well, we know FHA requires us to do this inspection. Conventional doesn't. So I talked to him about it, and I was like, well, how do you want to handle this? Because we can still do it, because his whole thing was he wanted to skip 2 months mortgage payments. And we were still dropping his payment $500 a month. So he did agreed. All right, let's just take it conventional. And then coincidentally, the house appraised with over 20% equity. Miraculously, like he had way more equity. He had way more equity. So for context here, let me pull it up real quick. I want to make sure you can't see my screen because it has private info. You can't see what I'm sharing.
Right? No.
So when we originally started, he was expecting his house to appraise at 510. And then I want to say it appraised over. Hold on.
So was he under contract at 510?
It was a refinance, so he's not.
Oh, refinance. Okay.
Yeah. So sorry. We needed the base loan amount to be about 510. He was expecting to come in around like 550. It appraised at 642.
Wow.
So we ended up taking him conventional and still closing it. And what's funny is, like, that an inexperienced loan officer, that loan's dead when that septic tank floods, right? Like, it's just dead because, like, well, there's nothing else we can do. But in talking to him, like, look, conventional doesn't have the same guideline. We can flip this, go conventional, and we can use the same appraisal. Is we can transfer an FHA appraisal to a conventional, but you can't transfer a conventional to an FHA. So we flipped it conventional, and we actually closed. That was coincidentally also my first 100% virtual closing, if we want to talk about technology and where it's heading right now.
Wow.
He closed at 10 p.m. last Friday. Not this Friday, but the Friday prior.
So I'm curious, why would he want to refinance if, like, what was his interest rate prior? Because if the interest rates are higher now, like, I'm just curious what the reasoning behind it was.
Well, I mean, his rate was higher when he bought it.
Got it. Okay.
Yeah, his rate was in the 7s. And then when we closed it,
he was still saving $500.
It ended up being, because we had to flip it. It ended up being like $450 a month, which is still significant. Yeah. But the most important thing was he came across some hardship, right? And he was like, I can't keep paying $4,500 a month right now. So what the refi was really doing, in addition to lowering his payment, was, hey, we can use the equity to then pay all of the closing costs, and I can skip 2 months mortgage payments, which is kind of what his goal was. And that was the main, like, lowering a payment was the cookie on top, but it was really just, hey, I don't want to have to make $9,000 in payments over the next 2 months, which is what it really was.
Like, when you really think about that, yeah, that's like oh my gosh, in 2 months. Yeah, I'm super blessed for I loved when I bought, because my mortgage is less than $2,000, and I'm like, and I know we've outgrown this house and all that, and this is going to be an investment and all that other stuff, but it's good for now. It really is.
Right. Yeah.
All right. We just have a few more questions. Okay. Watson said, when they give you 5 different banks, does that mean if you don't qualify with one, you can keep trying with the rest?
What do you mean by they give you 5 different banks?
Well, I guess he means, I'm assuming here, where it's just like, how do you know, like, how does it work? Where how do you know which bank is going to work best for the buyer?
Oh, well, I mean, we have in our system, I can only speak to what we have, but we have pricing engines that pulls in all the data from all of the different banks that we work with. So when we price it out, we can price it out in one portal, and then it prices it out with all of the different lenders that we have. Every lender that we have, though, has different guidelines, right? So it's not just who's offering the lowest price, but also, like, the get it done, right? Who can actually get this loan done? Because sometimes I can get you a lower rate, but that lender, a lot of times, like the best price lenders are ultra conservative, ultra conservative. So they may not be willing to overlook things. And if I'm looking at your loan and I think like, hey, there's this thing is a little bit questionable here. Probably don't send it to a bank that's ultra conservative, because when they look at it, they're going to say, no, I don't like this. Like, for example, one thing that's super common in this market nowadays is variable income, right? This used to not be a thing at all when I got into the business, where if you have a job that you typically average about 40 hours a week, and you send us 30 days of pay stubs and it says 40 hours a week, you're good to go. Whereas now, if you took a vacation for 3 weeks and you only had 1.5 weeks of PTO, the underwriter is going to say, hey, the year-to-date totals are off here, and they're not averaging 40 hours a week. So we can't use 40 hours in income. And this is coming up more and more and more, because lenders are starting to pull back and getting more conservative around those things. So now what we're doing when we're pre-approving people is we're doing what's called a verification of employment upfront, as opposed to where most lenders, they'll order it during the loan process. We're doing them upfront because even though there's a cost associated to it, I don't like having surprises. And I most certainly don't like having to go back and say, hey, we can't do this loan after I gave you my stamp of approval, after you looked at a million houses, the loan can't get done. I've had to do that early in my career, and I vowed that I'll do everything in my power to make sure that never happens again. And so, yeah, I mean, we've verified those things up front. And normally it costs like $75, but I'd rather have you feeling confident and certain when you're driving around. I don't know how far Ocala is from you, but I think it's like an hour and a half or something, right?
Mm-hmm. Oh
Like,
yeah,
yeah.
absolutely, yeah. Absolutely. That's why, and it's so funny because we had a client who there she lives up north in New York, and her daughter was talking to another lender, and but that lender was only like did business in New York and New Jersey. So when I spoke to the lender, like she really didn't know how things work here. Like what the average, closing costs are over here, right? Like she knew nothing about CDDs and all of that other stuff, because you don't have that up north. So
Mm,
that's why I say it's always important to go ahead and make sure that you're working with somebody who works in Florida. I personally think so, or who has it's very experienced and has done multiple, dozens and dozens of loans here, because then they know how it works, right?
right.
I had a disaster of a transaction, and I something in me told me, I was the listing agent and the buyers, and I called the buyer's lender, and I was like, hey, you do know that there's a CDD in here, right? And then she was like, what, there's a CDD? And I was like, oh my gosh. I said, because sometimes that can make or break somebody getting approved, right? So I'd rather check off almost all the boxes in the very beginning than be surprised at the end, right? Because then that's just a recipe for disaster.
Right.
Our current interest rate is at 2%. Do you think we will be able to buy with that type of percentage again?
No.
I don't think so either. I don't think so either. I agree. I'm super blessed to have a 1.99 interest rate, and even like my CDD I think went up like $50, and I'm like, I'm still under $2,000. Like I'm not I'm not
You flexing on us right now. She dropping 1% rates. It's crazy.
Listen, oh my gosh, that was a blessing. Okay, we're almost done. Janet said when we bought our house, the seller covered all of their closing costs. That was amazing. That is amazing. And you see that more and more happening now. But during COVID, that was unheard of, to be very honest with you, because people
Mhm.
were paying over appraised value. Some they were waiving appraisals, they were waiving inspections and all of that. So we definitely are in a different market. Um Okay. Okay. Marianne and Jeff says, thank you, Will, for your time. Yes, I'll give you his information. James said, great show, very informative. Thanks, Alexis and Will. Watson said, yes, that is correct. And then Eddie is saying leftovers can be reimagined into another meal. I agree with you, Eddie. I really, really agree. That is very true. Like you know what happens a lot? Thanksgiving, like Thanksgiving leftovers, you could do a whole bunch of different things and create a whole nother meal. But we
Mhm.
appreciate you. Definitely want to respect your time. It's a Sunday. I really appreciate that you took time to bless my YouTube family. And yeah, if you hold on, what's your phone number, Will?
321
Hold on, Will Butler, 321.
432
Uh-huh.
7905.
All right, so I'm putting his number in the chat so that you guys have it here. Um, okay, we have one quick question. Okay, how difficult is it to get a loan if you're retired, both husband and wife?
Not difficult at all.
Yeah, I don't think I've seen where a lot of our clients have both retired, right? It's all still gonna depend on credit. It's gonna
Mhm.
depend on income, like how much you make versus what your debt to income ratio is, right? How much you can afford. So it's still kind of this. Would you say it's still the same as far as it's basically income if you were working, kind of like that same
I think it's
structure?
even it's easier because it's fixed, right? The only guideline that you have to be cognizant of is the income has to continue for at least 3 years. So as long as that income will continue for at least 3 years, so if you're receiving a pension or Social Security, we already know that's going to continue for at least 3 years. Um, you just have to have the paperwork for it. But yeah, those I prefer those loans honestly because they're so easy. They're easy to do, and underwriter's not really going to question things. Um, and then a lot of times, like if those incomes aren't taxed, you can use more income than what you actually earn. So we can gross up the qualification. So $2,000 untaxed equals, you know, $2,500 as opposed to just 2,000 if it were taxed.
Yeah. Somebody said I am retired as well and purchased just before retirement and have so many questions that. Well, I put Will's information, his phone number in the. Don't call him now. It's Sunday. Let him hang out with his family. But definitely tomorrow, call him and he'll be happy to answer any of your questions. But I appreciate you, Will. Where's we need to put it on the calendar. Our next sushi date.
Oh yeah, 100%. Yep.
Okay. All right.
Thanks for having
I
me.
will.
All right, bye.
All right, guys. How was that? Did you guys love it? Or do you feel kind of like a little bit educated, right? Yes, pension and social security are permanent income. That's very, very, very true. Yes, so I'm glad. I like to have him on here. You know, things are constantly changing. Hold on. Here we go. Oh, the dogs are gonna start barking. No? Okay. All right. So things are constantly changing. So I like him to come on here so that he can educate us. And remember, I'm not a licensed lender. So he's the one who's licensed and he's does loans every day, right? And has come across very different very many. Does that make sense? Very many? A variety. Okay. Does very many? That doesn't even sound right, right? No, that doesn't even okay. A variety. Um a variety of different loans and things like that, right? So let me know, who else did or what kind of like maybe I don't know. I've had insurance agents on here, I've had inspectors on here, right? I would love to get an appraiser here. That would be nice. That would be really, really nice to do. So I am definitely taking the night off already. I'm tired. I've been working nonstop. Um, Amanda said that was awesome. I'm brand new and studying for my real estate license. Just found your channel. So glad I did. Wow, congratulations, Amanda. Definitely, um interview as many brokerages as you can. You can definitely have a conversation with me and my brokerage. Would love to have that conversation. Um, I know Toya. I know Toya. I was actually there, but I couldn't. I was with clients. Toya's like, when are you going to Apopka? Babe, we need to go to Apopka for Toya. I know Toya. I know. It's on my brain. I promise you it's on my brain. We need to go to Apopka, babe. We need to make it happen. So let me tell you a little bit about what's going on this week. So tomorrow and Tuesday, we did two videos in Wedgefield, which is in Orlando. It's about 15 minutes away from the Orlando International Airport. I lied, but not on purpose. I thought it was about 20 minutes to Port Canaveral, but it's actually about like 40 minutes to Port Canaveral. Um, what else? And it's okay. So tomorrow's video is a 4-bedroom, 3-bath, 3-car garage with a separate private in-law suite. It has its own entrance. It's on 1 acre. And then very, very beautiful house. You love the nails, Janet? Oh my goodness, I just got them done this week. You love them? Very spring. Spring. It's springtime, guys. And then Tuesday's video is in Wedgefield too. It's just a different video. It's a 4-bedroom, 3-bath, 3-car garage. And that one's actually on 1.24 of an acre. So I did those two videos this week. Pray for my son. So Elias, he's, and I've said it before, I think that he's he has pitting edema, and he just had an appointment with the nephrologist, and his liver is not working as they should be. I mean, not his kidneys, not his liver. His kidneys are not working as they should be. So we did a biopsy. It's larger than what it should be for his age. It's brighter than what it should be. And then we did blood work again, and his cholesterol is like 450. So the doctor's like, I think we really need to do a biopsy. So we're gonna go, he's gonna actually do that this Friday. So so keep us in your prayers. I really would appreciate that. Tomorrow and Tuesday. Okay, I'm leaving tomorrow. I'm going to Fort Lauderdale until Tuesday. I'm actually speaking on stage. So I'm excited about that. And then I'll get back Tuesday night. And then next Sunday is Easter. Phil, this is when you coming on? I mean, I'm confused, Phil, right now. Like, hi, Phil. I haven't seen you in a few weeks. I haven't talked to you in a few weeks. Next Sunday, there's no live. It is Easter. So we're just gonna, I hope everybody spends time with your with the family. Chavez said, what do you say with somebody who's trying to buy an investment property with this war? I mean, I'm going to be very honest with you. There's still people vacationing, right? There's still people that need homes. So it depends on what, if the numbers make sense, then I'm all for it. But it just has to make sense. Everybody has different goals and different situations, but everybody's still moving. Everybody's still vacationing, even though the prices have increased and your gas and your groceries and all of that. People still make it a point to go ahead and purchase, right? So, or rent, right? So if it's Airbnb, depending on where in Airbnb, right? Because a lot of the places are oversaturated. So sometimes where you're competing against a lot of people in, let's just say, the same community, and you have to reduce your nightly rate, but then you reduce your nightly rate, but then you increase the wear and tear of the house, right? So yeah, it's just gonna depend. Let me read these real quick. So no live next Sunday, okay? Because it's Easter Sunday, and definitely just want to lock in with my family, and of course I want you guys locking in with your family and having a good time. Yes, thank you. Prayers for Elias. I really appreciate that. I can put on the community post, since we won't have it until next the following week, just like that he's okay. What else? James said, respectfully, you are looking younger these days. Okay, thank you, James. I had a birthday. I'm 35, and I'm feeling good. I'm feeling good. Okay. Hi, Katie. Katie says she's new to this channel and she loves me. Thank you, Katie. Phil said, I've been here. I've been sick. Renee was home for a week taking care of me. Oh, I hope you feel better. I hope you feel better, Phil. Oh my gosh. Huh? Oh, Vic said, feel better. Why are you so good at stuff like that? Oh, look, Janet is like the nails. Yes, look, I love these nails. I love the color. I love the color. And then I have these hanging pearls, but yo, it gets stuck in my hair, and it also gets stuck in the sawana too. And then of course, we already know that I am the monarch of real estate, so we have the butterfly there as well. All right, guys. I gotta go. We're gonna have Chinese food. We're not cooking today. I love you guys so much. I hope you guys have an amazing week. Make sure you watch both videos this upcoming week, Monday and Tuesday. Toya, I have a popcorn on my mind. I know. I got you. I hope you guys have a great Easter Sunday, and we will. What is it? What day is it? Coming on the 12th. We'll come back on April 12th. Okay. All right. Love you guys.